Cap rates are one of the first metrics newer investors look at when analyzing a real estate deal, since these are easy to calculate, easy to understand, and can give you a really quick way to compare how different deals are valued. But even though these can be helpful to get a general sense of pricing, cap rates don't give you anywhere close to a complete view of an investment, and in some cases, these can even end up being somewhat misleading. So in this video, I want to break down why cap rates might not matter as much as you might think and what to focus on instead when evaluating a commercial real estate deal. So the first reason why you might not want to prioritize these within an investment analysis is that these can be very easily manipulated to push pricing on a deal. The cap rate is calculated by taking the going-in net operating income, or NOI, of a property and dividing that by the value of the property, meaning that the higher the NOI is in comparison to the asking price, the higher that cap rate is ultimately going to be. And since buyers that are focused on cap rates want to see that number as high as possible when investing in a property, both brokers and sellers are going to be heavily incentivized to maximize that going-in NOI in any way possible. In a lot of cases, this means that a property's advertised going-in cap rate will be calculated based on trailing 3 months or even trailing 1 month annualized NOI figures that very often reflect a best-case scenario. So on a multifamily property, for example, sellers might do things like postpone necessary or even regular repairs and maintenance to decrease operating expenses, offer aggressive leasing incentives to drive up occupancy or in-place rents, or even increase things like late fees or application fees temporarily, sometimes even above market rates. And on commercial properties, brokers will sometimes add future leasing assumptions related to space that's planned to be delivered vacant when the property is ultimately sold, assuming market or even above market rental rates, even though those lease terms have no guarantee of materializing. The key point I want to make here is that brokers have a lot of flexibility in how they present NOI figures to potential buyers of a property, and they're ultimately incentivized to use the most aggressive assumptions they can to maximize pricing, so you'll always want to run your own NOI calculations when analyzing a deal. Now, the second reason why cap rates don't tell the full story within an investment analysis is that these don't factor in debt financing on a deal or projected capital expenses, both of which can have huge impacts on the performance of an investment. The cap rate only measures the relationship between the net operating income and the purchase price of a property, which will obviously affect the economics of a deal, but the amount of debt used and the terms of a loan can materially change the cash flows to investors. For example, a property marketed for $10 million at a 6% cap rate would be projected to generate $600,000 in NOI for the investor in the first year of ownership, which is a 6% yield on an all-cash investment. However, if that same property were financed with a loan using a 65% LTV ratio, a 5% interest rate, and interest-only payments in the first year of that loan term, the same property would now produce a significantly higher going-in yield of 7.9% after factoring in debt. And on the capital expense side of the equation, if that same property has some deferred maintenance and needs $250,000 of work done in the first year of ownership just to keep the property operational, that investor's yield would go back down to less than 1% after taking all of this into consideration. The key takeaway here is that in a lot of cases, capital costs and financing terms can make or break a deal, and just looking at a cap rate when analyzing a potential investment ignores some of the biggest drivers of performance when investing in commercial real estate. And this leads directly into the final point I want to make in this video, which is by far the most important, and this is that cap rates don't tell you anything about equity returns on an investment. While a cap rate can be helpful to get a general sense of pricing in a market, investors get involved with real estate in the first place to earn a return on their capital, and those returns are ultimately measured using very different metrics. In this industry, investors will typically look most closely at the IRR, or internal rate of return, the equity multiple, and the cash-on-cash return, all of which can vary significantly regardless of the cap rate. In fact, in a lot of cases, properties with the highest amount of upside when it comes to NOI growth potential will often be priced at the lowest cap rates in a market, and properties with the least amount of NOI upside will often be priced at the highest cap rates in a market, which means that a 5% cap rate deal might end up being a significantly more attractive investment than an 8% cap rate deal, even if that going in yield isn't initially as strong. For example, let's take a look at a sample property acquisition in a slow-growing market where demand is weak and developers can easily build new product, where a property is priced at $5 million at an 8% cap rate. Let's also say that due to declining population growth over the last few years, lenders see this as a risky market to enter, and they're only willing to issue loan proceeds of up to 55% of the purchase price at a 6% interest rate, amortizing over 25 years, and we can only assume to see 2% annual NOI growth over the next 5 years. Let's also say that there's a lot of deferred maintenance of the property, which will require an estimated $175,000 per year in costs in the first 2 years of ownership, which are assumed to be funded by cash flow the investor would generate during this time. And if at the end of that 5-year period, we assume to sell the property at that same 8% cap rate we bought it at, we generate an 11.1% IRR, a 1.7x equity multiple, and a 5.9% average cash on cash return over this 5-year period. But now let's look at a different example in a quickly growing market this time, where demand is strong and there are major supply constraints in the area, where a property is priced at $25 million and a much lower 5% cap rate. But this time, let's also say that due to the growing population in the area, lenders see this as a relatively safe market to enter, and they're willing to issue loan proceeds of up to 65% of the purchase price, this time at a 5% interest rate with full-term interest-only payments, and we assume we'll see 4% NOI growth over the next 5 years. Let's also say that this time the property is newer and doesn't have any outstanding capital needs from the investor, and if at the end of this 5-year period we assume to sell that property at that same 5% cap rate that we bought it at, now we generate a 15.2% IRR, a 1.9x equity multiple, and a 6.2% cash on cash return, all of which are higher than the deal with the much higher cap rate. And this is a great example of why focusing too much on a cap rate alone not only doesn't tell you the whole story of a potential investment, but can actually make a deal look more or less attractive than it actually would be in practice. And if you're only looking at this one number, this can cause you to miss out on great investment opportunities or make subpar investment decisions overall. Now, the IRR, the equity multiple, and the cash on cash are all extremely important metrics, but there's a lot of work that goes in up front to creating cash flow projections that are used to calculate these figures in the first place. And if you want to learn more about how to build out a model to analyze commercial real estate investment opportunities beyond just looking at a cap rate, make sure to check out our all-in-one membership training platform, Breaking the CRE Academy. A membership to the Academy will give you instant access to over 120 hours of video training on real estate financial modeling and analysis. You'll get access to hundreds of practice Excel interview exam questions, sample acquisition case studies, and you'll also get access to the Breaking a CRE Analyst Certification exam, which covers topics like real estate pro forma and development modeling, commercial real estate lease modeling, equity waterfall modeling, and many other real estate financial analysis concepts that will help you prove to employers that you have what it takes to tackle the responsibilities of an analyst or associate at a top real estate firm. If you like this video and want to see more content on different return metrics or finance terms that are commonly used in commercial real estate, make sure to hit the like button and let me know. And let me know in the comments how you use advertised cap rates when analyzing a real estate deal. As always, thanks so much for watching, guys. I hope you found this helpful. Subscribe to the channel if you haven't already to see more videos like this every single week, and I'll see you in the next video.